Hello Sky Traders, welcome back to a new YouTube video. This is me, your trading coach, and this is your weekly recap. So this week we're gonna look into euro dollar, and as usually, we don't only do a forecast or analysis of what happened during past days or weeks, but we also try to understand some concepts that is gonna make you money and make you successful in trading, right? Because being successful in trading is really important, and it's not only focusing on money or making money, it's focusing on the process. Once you have a solid process, even if you're not making money right now, you're going to make money in the future. And right now can be today, can be this week, can be even this month. The future can be next hour, next day, next week, next month, or even next year. This is what we call consistency. If you have a trading strategy and you have a solid plan and you have a good results of testing your trading strategy, then you're focusing on the process. You're not focusing on the money. You're going to be successful in this, right? Because sometimes you lose. Some trading strategies are 30% win rate, others are 80% win rate. So imagine if you are losing 7 out of 10 trades, and if you're not consistent and if you don't trust your process or your plan, eventually you're going to blow up your account. But if you know that you're trading a trading strategy that has, let's say, 1 to 10 risk to reward ratio, but 30% win rate, then you need to lose 7 out of 10 times. Some other trading strategies have like 80%, 70%. So you're only losing 3 times out of 10 trades. So you need also to be sharp, to have a sharp mindset and understanding that focusing on the process is more important than focusing on the money. And when mentors say that, hey, you need to focus on the process, you need to focus on the consistency, this is what we mean. If you don't understand what kind of consistency, this is consistency. Consistency is that you're trusting the process, you're doing exactly the same thing that you know you should be doing because this is your strategy, this is your process, and you don't care about money. You care about numbers of your strategy. That's why you need to test your strategy. Because if you don't know that you have a strategy of 50% win rate or 30% win rate or 70% win rate, then how would you trust the process that, all right, I have to lose 7 times out of 10 times because this is my strategy? Or I have only to lose 3 times, or I have only to lose 5 times. And when I enter trade, this should be my entry point, and I have to have a 1 to 3 or 1 to 2 or 1 to 10 risk reward ratio. This is how it works. It's always a combination between risk to reward ratio and win rate. And this is what we call risk management. So today, we're gonna discuss and mention a trading strategy that you can literally be profitable, make a lot of money, but you have to trust the process, you have to understand the concept, consume it, test it, implement it. And also we're going to do the forecast using this strategy. There are tons of strategies that you can apply. You just need to pick and test the one that's suitable for your personality, for your psychology. We don't have the same psychology, right? Some people, they can withstand 1 to 3 risk reward ratio. Others need only 1 to 1 because they don't have the psychology to sleep on their profits or wait long to take profits. Others, they can't stand having 30% win rate because if they lose like 5 times or 7 times, then you're gonna blow up your account. So you need to focus, all right, I need a strategy that can bring me 70% win rate, but 1 to 1, for example, risk reward ratio. So it's always a combo between both, right? Today, we're gonna discuss a concept that can make you millions, thousands, but you just need to be consistent and sharp. Without further ado, let's jump to the charts. Let's discuss the strategy. And as usually, I highlight the days depending on different time zones, right? Or trading sessions. So let's do this. This is the 4 hours time frame, right? And I want to highlight 3 important things that's going to make this strategy work. Okay? Risk management. Okay. Entry point. And last but not least, time / price. All right? We're going to focus on these 3 things. This is what makes up the strategy that we're talking about. Risk management, time price, and entry. So in this concept, we're gonna just focus on the 3. And by the way, most of the concepts, most of the strategies, they are aligned together. It's just how you see them. You can find an order flow trading strategy is aligning with a time price theory trading strategy, is aligned with trading volume trading strategy. They are all aligned because it's the same concept. It's the price action. Once you understand the price action, it's basically the same. It's how you see and look into the price. What are you looking at? Are you looking at only time? You're neglecting other factors. Are you looking at volume? Are you looking at order flow? Are you looking at order blocks? Are you looking at liquidity pools or liquidity voids? But all of them, they are price action. You're understanding, you're studying, and implementing price action in your chart. We discuss a lot of strategies, and we're going to discuss hundreds of strategies. It's just you need to pick one that best fits in your psychology, behavior, and you can do it, you can test it. That's why you need to keep it simple. You need to pick a strategy that works for you. So, risk management. Let's look into the chart, right? This is our trading range, correct? And we have highs, lower lows, lower high, lower low, lower high, lower low, lower high, lower low. So let's first agree on a point, okay? Let's agree on a concept. Let's highlight this block, and this is the block that we are trading in, all right? First of all, if you're trading within a trading range, whether you're gonna break this range, trade to the bottom, trade to the top, trade to the 50%, we need to highlight 3 important levels. The bottom, the top, this is in case if you are an uptrend, and the 50% Fibonacci retracement level. You can do it by your eyes if you are experienced, or you can just draw the Fibonacci retracement so you can highlight the areas. And again, really important point in here. You need to be flexible. So it's not that, hey, this is the 50%, so if it breaks it, oh yeah, I know that it's gonna continue to the bottom. Or if it touches the 50% and rejects, then oh, it's gonna reject and now I need to buy here or sell here depending if it's an uptrend or sell trend. Again, you need to be flexible. It needs to be an area. It's not a line. So this is the 50% Fibonacci retracement levels, right? It's an area. Correct? So this is the area that we're looking at. Usually, by the way, it's from 50 to 62%. And this is the top. This is the bottom. This is our trading range. So, and we know if we're an uptrend, we're creating higher highs, higher lows, if you're in a downtrend, we're creating lower lows, lower highs. It's basic trading concepts. So let's agree on something. If I want to take a trade here, I'm not going to put my stop loss at the top. I'm just going to put my stop loss, usually, at the previous lower high. So if I'm entering a trade in here, this is my stop loss above this, because usually when traders or retail traders, they put their stop losses in here, markets sometimes they jump to take out all of the liquidity and then continue the downtrend, or vice versa. So you need to be also flexible when putting the stop loss. It's not about, hey, this is the lower high, so I just need to put the stop loss right there. You need to understand, that's why we're studying price action. You need to understand how market works. If all of the retail traders are putting their stop losses there, this is a high potential liquidity area. So sometimes market might takes it to kick out all of these traders, gain liquidity, have this potential or volume to continue the downtrend or the uptrend again. And it happened here. Let's focus on this. Let's zoom a little bit. What happened in here? This is stop losses of retail traders. Market went up, took all of these stop losses with a high buy pressure buy candle, followed by a high pressure sell candle, which means that we took already all of this liquidity, creating an order block and then breaking this market structure, right? Perfect. So let's agree on a concept. When you put your stop loss, we're not putting it at the top of the trading range. You're just putting it at maybe 5-6 pips higher than where the previous lower high, in case you're trading a downtrend, or the previous higher low in case you're trading in an uptrend. This is the first concept that we agreed on, which is aligned with the risk management. All right? And you're not going to put your take profit at the lower point of the trading range or at the higher point of the trading range if you are trading again an uptrend. So you're also should be skeptical and understand where you should put your take profit, right? So now we know exactly where we're going to put our stop loss, take profit, and we understand the concept that we're not trading the whole range. If you want to do this, then it's high risk to reward ratio. Then at this point, you might face low win rate. And again, especially that this level is really important, which is the 50% to 62% Fibonacci retracement level. So another point that you need to take care of, this level. So once you reach this level, I'd recommend to stay out of the market, which means if you have a trade, this is the perfect time you close the trade. Or if you want to enter the trade, this is the perfect time to see and observe what's going to happen from this level so you can understand if you're going to go long or short. Especially if it's aligned with previous market low or market high, in case if we're a downtrend or uptrend. So now we know about stop losses, in this case, take profits, and 50% Fibonacci retracement, correct? Let's move to the second point, which is the time price. If we go down to the 1 hour time frame, you will usually find, and now I'm highlighting Asian session, London session, and New York session, right? See what happens during these sessions. Asian session, we created the high, taking out the liquidity of previous lower high, which is what we discussed, that if you're putting your stop loss in here, or if you enter the trade in here, you would not put your stop losses in here. You would leave a room 5, 6, 7, 8, 10 pips in case the market want to kick out all of the retail traders, so you're safe. In Asian session, high pressure sell candle, trying to trade back, creating an order block. In which trading session? London session. Creating a high pressure sell candle, then another high pressure buy candle, creating another order block, happens during New York session, with a high pressure sell candle breaking this market structure, and this is what we're looking for. So if you want to take a trade, you would wait for the market to trade back to the market structure that was previously broken. In this case, you can take a trade, or at some points or sometimes the market never trades back. So you're just not gonna, you're gonna miss this trade, which is fine. You don't need to enter every single trade. So again, if you put a trade here or you take an entry in here, where are you gonna put your stop loss? 5, 6, 7, 10 pips higher than the previous market high. Where's gonna be your next take profit? Next previous market low. Why? Because there where liquidity sits, and there where the market is waiting or is hunting to get liquidity. You can cash out 60% in here, 50%, 70%, again, depending on your trading strategy. Let's look at the second day. Asian session, we're trying to trade back to the previous broken market structure. London session, what happens? We took out the Asian session, order block, high pressure sell candle. So we are waiting for this every single day. And once this happens, that means that the order flow or the liquidity is going into this direction. So usually, if this we are waiting, if this could usually happens in London session, New York session, because this is when most of the liquidity sets on. Trading back in which session? New York session, again, high sell pressure candle, targeting next low, and then once we took out all of this liquidity from previous lows, we're trading back because we kicked out all of these traders. And again, next day, what happens? This is the Asian session. We took out the previous liquidity in London session, and we took out the previous liquidity from the previous low in New York session with a high buy pressure candle, and this is in use. And whenever there is a news, but the order flow is in sell direction, so we need to take more liquidity from previous highs. That's why, again, if you're entering a trade in here, you would never put your stop loss in here. So what I'm saying in here, that once you highlight 3 important time zones or session, Asian, London, New York, this is what all of the action happens. Then the entry, which is the third wheel. Combining both risk management, time price, you can't find the entry. You can find the perfect entry. And again, you need to understand 2 important things: entry point and exit point. For instance, if you're going to enter in here or take a trade in here, right? And you know right now that I'm going to place my stop loss at the previous market high, which is in this range. And I'm gonna leave a room for 5 to 10 pips for in case the market wanna take out all of the retail traders. So I'm gonna put it in here. And this is also aligned. If I'm gonna put my stop loss in here and the market breaks it, the market now is breaking a market structure, a previous market structure. So more likely we're gonna go up. That's why you can even get a confirmation for the next trade. It's not only about I'm putting my stop losses at a safe place, but it also can be an indicator for the next trade. If I'm losing this trade, I'm going to take the next trade, right? And if you put your stop loss in here and you take the entry here, right? And the next profit target or first profit target is the previous low, and then the next low in the trading range, which could be this, this, and this. You can definitely take, let's say, 40% in here, another 20% in here, another 20% in here, and so on, maybe until you reach the 50% Fibonacci retracement level in case you're trading in a range. And by the way, this is usually happens when you're in an upwards order flow, consolidating, can break a specific market structure or specific levels, then trying to trade back. So there are 1, 2, 3, 4, 5, 6, almost 6 or 7 opportunities that you can trade in the market. So how about if I lose, if I enter a trade in here and I lost it? The next trade, should I overtrade or like take the double risk? Yes, we do this in case you're gambling. But what we do in here, in case you're a real trader, is take a trade with the half of the risk. And maybe now you need to increase the risk to reward ratio. So instead of taking 50% on the previous next previous low, you're gonna take only 30%. This is what we call risk management. It's a game, and you need to be flexible with this game. So now, based on what we discussed, you are the ones that are gonna create the forecast based on what we discussed in here. Now it's 50-60% Fibonacci retracement level, right? What we're looking for. Market to reject. Then this is the bottom of the next trading range. So this is gonna become the bottom and this is the top. And we are gonna trade again and take care of the next 50 Fibonacci retracement level, and then maybe we can take the previous highs and so on, or Mark's gonna create another low, and then we can have like 4 or 5 more entries until the bottom. Go check your charts. You can easily make a lot of money from these setups. You just need to understand what kind of setup that best fits in your psychology and trading behavior. Thank you so much for watching. This is Mina, your trading coach, and see you in next videos.